Welcome back as we take a look at AP Econ for macroeconomics, looking at Unit 2, chapters 23 and 24. Are you living the 5? I sure hope so. Okay, let's jump right in. We're looking first at chapter 23, macroeconomics, the big picture. Let's start by looking at the business cycle. We talk so much in macro about the idea of cyclical aspects, cyclical unemployment, the idea of something being cyclical in nature, deviating from the cyclical approach, and the business cycle is so important here. We got to think of this in terms of the business cycle being the periods of expansion or recoveries, if you will. The idea that the economy is improving, businesses are opening, people are hiring, jobs are being created. We have peak, which is the top of the roller coaster of that expansion, where you don't know you're in it until you've already started to fall. And the idea there is it's at the top of the game. Usually that's like record-setting type of situations, like the 11-year expansion that we had up to and including through February or March of this year. And the difficulty is, again, not knowing how to predict that. Who would have thought it could last for 11 years? Who would have thought that coronavirus would end it? But the idea is that's an expansionary period. Then we don't know we've hit the peak until we've already started to fall off the roller coaster, just like that moment of being airborne. And then we start to go into a period in which businesses are closing. They're laying off workers, or they're cutting back on their hours, or they're letting people go, or significant areas are losing jobs and businesses are closing rapidly. These are leading to recessionary times. If you stay there too long, it gets into, or it's too vast and too wide, you have more of a depression on your hands. And think of it like the Great Depression, where essentially 25% of the workforce was basically out of work. And in some parts of the country, unemployment was even higher than that. It's very deep. It lasts very long. It's a significantly difficult time, very scary and very hard to get out of, and very hard to get people to come back from that changing the psyche about the concerns around it. So the business cycle here, we have expansion, we have peak, we have recession where we're falling, and then trough. If we stay there for a deep and prolonged period, you essentially have a depression era type of situation. And that essentially is the business cycle, or what we're referring to as the business cycle here. Now, the idea of a recession is usually 2 quarters of negative growth. So think of it of 6 months in which you have aggregate output that is falling, meaning real GDP is shrinking, not moving outward but inward. Okay. Now sometimes economists will cut back on that and say, whoa, that's way too hard. And so there's a lot of cutback, back and forth on this. But GDP is a good indicator of whether we are moving forward into expansion or whether we are not. And sometimes other factors have to be taken into consideration, of course, beyond our control. But the idea, nonetheless, has kind of stuck in that most economists look at 2 quarters or 6 months of negative growth, or inward moving GDP, or stagnant GDP, in which it's not moving or negative in nature. Would be this idea of recessionary period. And then expansion, obviously anything where real GDP is growing as a result of this. So we kind of see that a little differently there. So what can you do about it? Well, you can look at some of the indicators and try and improve that growth. We're going to see that in macro. It's all about how the government and industry can really affect the economy and what they can do to get to encourage expansion and to get us out of a recessionary type of times so it doesn't lead to a depression. And that's important. How do we improve aggregate output? How do we improve real GDP? How do we use government policies, both monetary and fiscal policies, in order to help grow the economy and get things moving again? And that is so important. No more important in terms of what we're going to talk about than with unemployment. If people aren't working, they're not getting paychecks. If they're not getting paychecks, they're not paying their mortgage. They're not going out and buying things that our economy is driven on, and that kind of folds in on itself. So the importance of the labor force cannot be underestimated here. Having people working in the economy, putting people to work, and getting people to actively seek out work and being able to find it, that is more important than anything. If people are looking for work and they can't find it, you think of the Okies back during the Great Depression. If you've ever seen The Grapes of Wrath or read that book, phenomenal book by F. Scott Fitzgerald. But the idea there is that if you aren't able to find work, then that's a problem that's bigger than you. If you're structurally unemployed, that's one thing. Government can step in and help to get you the skills. But if there's just no jobs there, that's a bigger, deeper problem than what you as a consumer or a factor of production can solve. So since 1948, we've kind of seen this unemployment rate and recessions go hand in hand. So you can see the peaks are with the purple columns, and the reason for that is because of the unemployment pressures that we have there in terms of what is happening with unemployment. So you can see at the peak of the late 1940s, you have a recessionary time, and unemployment is rising. When times are good, you see unemployment is very low, and then you can see it rising again, and we see this in the mid 70s. We see this in the early 80s. We see this in the 83, somewhere around in there. And it really does mirror if you have negative real GDP growth, you're not producing, you're going to have negative employment. You're going to have people losing their jobs. And so there is a correlation between the two. Now, we also have discouraged workers that weigh in on this because it's not just the unemployed, but people who actually leave the workforce saying, well, I'm tired of looking for a job and not being able to find one. I'm just going to stay home and take care of the kids for a while, and then I'll find a job 6 months from now. So those people aren't included in unemployment. Remember, they're not ones who are actively seeking work, so they don't count. We also have underemployed, okay? And these are people that either work smaller number of hours or are getting, very low-paying jobs, and they're counted as employed, even though they may not be making ends meet in terms of a living wage that they're able to, pay their mortgage and pay their bills. So underemployed is a significant factor here too, because here you're looking at, the unemployment rate is low. Well, it may be low, but, you've got a lot of people that aren't working 40 hours a week, that, maybe they're down to 30, and maybe they're making minimum wage, and there's a lot of other factors weighing in on that. So the unemployment rate doesn't tell that story either, and that can be rather frustrating. And leave us with a little more caution about the unemployment rate itself. So how do we get the unemployment rate? Well, we take a ratio. It is the number of unemployed workers divided by the number of unemployed and employed. So the labor force as a whole is made up of employed and unemployed workers. And so we would use that as our denominator, and our numerator would be the number of unemployed workers. That'll give us the unemployment rate. And then multiply that by 100 to get a percentage. But that's essentially how we get the unemployment rate. And we can, again, keep in mind that that's not going to include discouraged workers or the underemployed in that number. So the unemployment rate could actually be higher, and in some cases much higher. Now, the numbers that have just come out recently have showed that about 22 million people in the last 3 weeks have fallen out of work. And there were only under 500,000 that were in that before. So 21.5 million in the last 3 weeks. About 7 million or so each week have lost. And we have a significant number of people that are going to be filing in the next month that weren't eligible to apply before. And so the next couple of weeks are going to be some pretty rough numbers, I think. So to be continued. We'll see what happens there, but not good. Now, obviously, as I mentioned, there is a relationship here between unemployment and aggregate output. Just like we talked about with Oakens Law, the idea that as real GDP grows, unemployment is going to be falling, not by a 1-to-1 ratio. But the same is true if we're moving in the opposite direction. If we have a period of expansion in which real GDP is growing, your unemployment rate should be falling. And if we have a period in which real GDP is falling, you'd have unemployment growing. And it's not a one-to-one. Unemployment will fall or rise at less than what the aggregate output is, what real GDP is actually growing here. But the idea is the same, that there is a linkage, there is a relationship, an inverse relationship to them. So as real GDP grows, unemployment falls, and as real GDP falls, unemployment will grow. But again, not at a one-to-one relationship. So there's a lot of stabilization policies that the government's going to undertake in order to try and fix this. And we see some discretionary spending. We see some automatic stabilizers that kick in, like unemployment checks and unemployment checks and welfare, food stamps, types of programs that are in place that automatically kick in when you file for benefits and that kind of thing. Government doesn't have to have Congress pass a law and the president to sign it. It kind of automatically kicks in once somebody files for unemployment. So those are kind of automatic stabilizers. But stabilization policies can take two different types of effects in terms of government's impact here, and that's monetary, looking at the Fed, how they impact how much money is out there, including what you're giving, what you're contributing, and what you're expanding in the monetary base, that then would be used to loan out money to individuals, consumers, businesses, and that sort of thing, as well as interest rates. And this is the bird policy we talk about in monetary policy. So bonds, interest rates, lowering the reserve requirements to encourage banks to loan out more money, and lowering the discount rate to encourage them to loan out more money and then borrow at a lower rate from the Fed or another bank in order to meet their lower reserve requirements. So all that's monetary policy that the Fed can use to help stabilize the business cycle, especially in times of recession. And the Fed, we can see right now, is doing a lot of that in terms of trying to impact change and stem the concerns of recession. In this crisis. Now, during in looking at stabilization policies, then the fiscal policy is what Congress and the president would do. This is more fiscal street, the spending and taxing approach. So what they could do with tax policy in terms of cutting taxes in recession to encourage more spending, to encourage us to spend our way out of recession, as well as spending more from the government, and again also creating some crowding out, which we'll talk about in Unit 5, but the idea is there that government spending is going to encourage more consumption spending and business spending, encouraging real GDP to grow and to get out of this recessionary period. So that's really important in terms of these two stabilization policies, and we'll look at them in a lot more detail in subsequent units. Let's talk for a second about aggregate price level as we kind of get our bases around closing out this chapter. The aggregate price level essentially is looking at what are changes in prices over time, okay? And a nominal price level essentially is looking at this with inflation being included in that particular number. So there's no adjustment for prices over time. A real measure, and the best example here is interest rates. If you have nominal interest rates versus real interest rates, or nominal GDP versus real GDP, inflation is going to be the key factor here. So if you have nominal GDP, that's going to include any inflation that's in there. So it's going to show you a greater number than actually the economy was really producing. Real GDP is going to take inflation out of that number. So it's actually going to be a true number in terms of what the economy was actually producing. What kind of growth are we really seeing in the economy? Real GDP is going to be a better indicator of that than nominal GDP. And as I said, aggregate price level is basically telling us what are our prices over time in the economy, those price levels. Nominal is going to include that inflation rate. Real would not. Okay, so looking at inflation and deflation, and again in Unit 5 we talk a lot more about this in Chapter 33, looking at inflation, deflation, disinflation. The idea of inflation working in reverse is essentially disinflation. But the idea here is when you look at the inflation rate, that's going to tell us how much prices are stable and whether or not price levels are changing rapidly, what impact that may have on the economy. Could lead to If inflation starts to wane when it was going up really fast and all of a sudden it starts to stop, that could be an indicator short run that unemployment is going to be rising, so real GDP may be falling as a result of that, based on the Phillips curve. So it's definitely an indicator for economists to take a look at, and the Fed definitely keeps its eye on inflation to determine what they may need to do to step in to keep inflation from rising too quickly, because inflation, if it's rising too quickly, could also be shifting the curve, could be shifting the Phillips curve outward and leading to more unemployment as a result of that higher inflation. And that's not a situation you want to get into. That's the late 70s, the Jimmy Carter conundrum, the Carter conundrum that they had at the time, because when you've got inflation rising and unemployment rising, essentially that SRPC curve is shifting outward and outward and outward. And how do you stop it? And the answer is, it's really hard. It takes a lot of time, and he even had a bigger problem because it was a supply shock. And you can't just throw money at it, because then you've got more inflationary problems you're adding to it. So it takes longer to try and resolve that particular issue. Okay, so a closed economy, this would be autarky, right? This is the idea that we talked about in the previous chapter, in chapter 17, about the idea that the country's economy isn't trading goods and services. But an open economy is really what we have today. I mean, we are a globalized society. We trade with lots of different countries, and okay, there are some we don't trade with. Some are on terror watch lists or whatever, and those are out there, but they're unique in nature. Most countries we tend to trade with different products, goods, and services, and we tend to export to those countries as well as import from those countries. So we definitely have an open economy in terms of that respect. And there are rules and regulations guiding that. There's a lot of conversation around how that plays out, but it is more of an open economy than anything these days. And so that is determined and regulated by trade agreements that are in place, treaties, exchange rates, interest rates, what we call capital flow, that we'll talk about more in Unit 6, which isn't covered on the AP exam, but we'll talk about it after the AP exam, and the idea of how these exchange rates take place. What is the price of what is the value of a dollar in relation to a South African rand, or in the relation to a yuan? What are the different aspects of that? And what is a trade balance in terms of, do we have a positive or negative trade balance in relation to these other countries? And what do we do about that when President Trump's been very big on trying to correct those trade imbalances when an adjustment is needed in that respect? So there's a lot of that type of dialogue going on in an open economy, and that's normal. But the overall, let's go back to chapter 17 here. The overall approach is, we have an open economy because there are gains from trade, because we can produce products and services at a lower opportunity cost that we can then trade to other countries and consumers in those other countries, that we can gain from that trade. And likewise, they can trade with us at products that they can produce for a lower opportunity cost that then we can benefit from in buying those products, and so we don't have to produce them domestically. We can focus on the items that are more lucrative or more profitable in nature for us. Okay, so that closes out that chapter. Let's move on as we talk about this idea of the flow of money over the open economy. Let's kind of talk about it in terms of the circular flow when it looks at the economy as a whole. And that's what we're going to do in this particular chapter. So if you remember the old circular flow diagram we had back in chapter 1, the idea here is it's a little more complicated, because you'll notice we've got a lot of other players in this. In that we have financial markets in addition to factor markets. So there's a lot of exchange rates going on. There's a lot of financial aspects of financial services, and the services aspect of goods and services that are being sold in relation to that. And industries that are created, such as the accounting industry and the insurance industry and the there's a number of them that are more selling of services, not necessarily goods, that we provide. And we're a much more services-based economy today. So there's a lot more, and a lot of that's going to other parts of the world, and that we're selling those types of things to other parts of the world as well. So there's a lot of exchange of that going on here, and we see that again. You are the center of your universe. The economy does still begin and end with you. You are a factor of production. You are a household, and you in turn work as a factor of production to earn wages that then you use to spend in the marketplace as a consumer for goods and services that you are going to buy. That contributes to GDP, which then goes back to firms. Firms can use that to pay wages. They can use that to buy other investments in other types of goods and services that they're going to produce. They can import different items from the rest of the world. They can export items to other parts of the world. They have a lot of that impact, and they can sell to the government in addition in terms of what's going out there. So the financial markets can do the same. They can borrow from the government. They can borrow from other parts of the world. They can issue stock to different firms and help with those stock increases, and we see a lot of that financial aspects of trading and investment houses and mutual funds and all kinds of things today that are part of that financial services type of industries. Billions of dollars that are trading hands electronically, nothing necessarily trading on paper, but those services being sold to domestically to households here, also to other parts of the world. And those are contributing to GDP as well, and contributing to all kinds of aspects of the overall economy. So this circular flow is a bit broader in that it includes now, instead of just factor markets and households and firms and goods, now we've got the government involved. We've got other parts of the world involved. We've got financial markets involved in addition to factor markets, and it's a much greater economy than we saw before. But you are still the most important part of it, because without consumption spending, 75% of our economy, poof, it's gone. It is driven, and most economies today are driven by consumer spending, by consumers, and that trade, and that specialization of trade based on lower opportunity costs and comparative advantages. So that's really important here. Now, if you remember, the national accounts, essentially these financial markets, if you will, is looking at private savings being channeled into firms for investment spending and that sort of thing. We see this as the financial markets. Government can also buy goods and services here in terms of what they're sharing, just the same in terms of what they're putting out there. But likewise, you also have individuals and consumers and businesses abroad that are investing in these particular areas. The College Board is actually changing this rather than calling it national accounts or the financial accounts. Looking at this as what they call capital and financial accounts, or the CFA, is really a new term that they've kind of come out with this year in terms of trying to address that. But government purchases can impact this. And remember, the overall economy is made up of consumer spending, investment spending, government spending, and net exports. So government purchases of these and government borrowing in these aspects definitely can impact these markets as well. So generally, we would see exports from services that we're basically sharing with or selling to other parts of the world, while imports would be funds that are coming in to us from other parts of the world. And our GDP is impacted by what we export, not by what we import. So the total dollar value of all final goods and services produced in our country within a given year that are final in nature, remember final goods and services, doesn't include intermediate goods, doesn't include secondhand goods that are being sold, like a used car or an old house that's being resold. That kind of thing would not be included in GDP. But new goods and services that are final in nature, that are being sold, that are being produced in our country, within our borders, from sea to shining sea, within a given year, calendar year, January 1 to December 31, would be included in GDP, or gross domestic product, is really how we take a look at that. So that's the overall calculation. We can calculate it in a number of ways. We can look at that in terms of what I mentioned. We can add it up from all the producers, the value that they're creating, or what we see as a value-added tax, right? That's kind of been popular over the years. So we can see the value that's added by producers. And a lot of times, economists will look at these three different factors to make sure that the GDP is what we say it is, to kind of double-check their work. We use CIGNX as the most common one, which is the middle here. GDP is consumer spending, investment spending, government spending, and net exports, or exports minus imports. Also what we could look at here. And then we can add up all the income that's paid to the factors of production, to paying for natural resources, paying for human resources, labor, and paying for capital resources. And that's another way to calculate GDP. So if you're trying to take a look back at what's included in GDP or not, that's a really good factor. As an economist, I can look at the value added of all producers. I can look at our normal calculation of GDP, and then I can look at income paid to those factors of production in order to kind of double check my work to see that the GDP is in fact what we really say it is. So we can look at the value of all of those sales in terms of what's added up. That would be the first one we talked about. We can look at the value that's added per firm in terms of what I talked about with that first item. And then we can look at all of the total payments to the factors of production, that last item that I mentioned that we see here. So the first one, the second one, the third one, all of these will add up to the same dollar value, which essentially is how we calculate GDP. Now, what's included and what isn't included, again, what's in anything produced domestically that is a final good and service, also new construction, and any changes in inventories. You're producing new cars or producing more product. All of that's included. What isn't included are the intermediate goods, as I mentioned. Any type of inputs or resources that, again, resources aren't included because they're intermediate goods. Anything that's used, a used car being sold, is not contributing to GDP. Financial assets, stocks and bonds, not included in GDP. Again, the services or the items in terms of I'm a financial advisor, I'm giving you a transaction fee, that's included for the stock sold or whatever. But financial assets like the stocks and bonds themselves would not be included in GDP. Any fees that I would pay would be included as part of that. And then anything produced outside of our borders, even if it's by an American company, if it's produced overseas, it doesn't count. It would count if it's made in China, it is contributing to China's GDP, not ours. Even if it's made by Apple, it doesn't matter. That would contribute to the GNP, which is the gross national product, which is looking at what all American companies produce around the world. But that's not an indicator of our economic health because it's about what's produced within our borders. So that really makes a big difference there. And then if we look at real versus nominal, I kind of talked about this before as it related to inflation. But real GDP is basically taking inflation out of the overall GDP to look at what the actual numbers are. And the best way to do that is to use a base year price and calculate nominal versus real GDP to see what is the so if I know what the inflation rate is, I can multiply that by the nominal GDP and take inflation out of that GDP number, and that gives me the real GDP. So real GDP per capita then is just dividing that real GDP number by the number of our population. So divide real GDP by 327 million, and you would have real GDP per capita. Okay, nominal GDP is the overall number, which would include inflation in its overall gross domestic product. So it wouldn't necessarily be a good indicator of the growth of the economy because of the fact that inflation is in there too. So if 10% of that overall growth rate is 9% inflation, well, then the economy really didn't grow that much because inflation is 9%. If anything, you're looking at probably a shift in the SRPC or the short-run Phillips curve because you have inflation rising and probably unemployment rising as well. So not a good combination. And that's why economists really like to look at real GDP more than nominal because it tells a better story. And obviously, if you have real GDP that is growing, you're going to see unemployment falling. And this is Oakens Law that we talked about before. The idea that if real GDP is growing by 1%, the unemployment rate will be falling by less than 1%, but pretty close to that in terms of there is a relationship, an inverse relationship between the two. in terms of the price index, this is another indicator then of the overall economy by looking at prices, and this measures inflation. The consumer price index is the most common one, or CPI. Think of it as going in a giant each month and putting the same items, the same goods you're going to buy from the supermarket into the basket and then tallying up what the basket is worth. That gives us a price index. And in this case, with Giant, it gives us a consumer price index of how much these goods cost. Next month, I go back into the Giant and I put the same goods back in the basket. I ring it up again and see how much it's worth. And that tells us month to month, year to year, what kind of inflation is at work here, in that prices are rising faster than what people are being paid, what the market rate is, and that's leading to inflationary pressures that could be causing and could lead to a slowdown in real GDP, leading to a potential recession. So that's where the Fed steps in and says, "Hey, we really want to make sure that we keep inflation at bay. So do we sell bonds in order to slow the economy down? Do we raise interest rates? Do we raise the reserve requirement? Do we raise the discount rate? What do we do to help slow that inflation?" And the price index is a really good indicator of doing that. And by the way, they mentioned price index here because consumer price index is one of them, but producer price index is another. And economists can kind of use that as a backstop if they want to measure the producer price index, because that can tell you where consumer prices are headed. If producer prices are rising, the consumer prices will shortly follow, because producers will be passing along those price increases to their customers. So ultimately, that will lead to more inflation as well. Okay, so the price index is essentially calculated by looking at the cost of the market basket in a given year divided by what that market basket cost was in the base year. So if you're comparing it year to year or month to month, you would put the new one on top and the original on the bottom, multiply it by 100, you would get your consumer price index or your rate of inflation as a result of that. And obviously, if you look at year 2 to year 1, again calculating your change is looking at year 2 minus year 1 over year 1, or the new price minus the old price divided by the old price times 100 is going to give you your CPI, as we talked about in the last example. And that's going to tell us whether prices are rising and inflation is a concern, or whether it's lower than 3%, which is usually not as much of a concern as it would be if prices were higher than that. Okay, and then producer price index, as I mentioned, is another good indicator because it tells you where consumer prices are headed. If producer price index, or the PPI, is rising faster this month than CPI, then chances are next month or the month after, CPI price will probably be rising, and that's of concern. And that leads us to this idea of the GDP deflator, this idea of looking at nominal over real GDP and taking a look at how quickly is inflation or inflationary pressures really having an impact here. And again, you just divide nominal GDP divided by real GDP times 100 would give you that GDP deflator. And you would use that to determine whether inflation, again, another indicator of whether inflation is a problem that the Fed would need to take a look at and do more about in order to try and slow the economy down, keep those inflationary pressures at bay. Congress and the president could do the same through fiscal policy, but it's more likely that the Fed would take action before Congress would in terms of making that happen. Okay, so that ends Chapter 23 and 24 and Unit 2 of Macro. Next, we'll be moving on to Unit 3, looking at Chapter 27. I hope you live in the 5. Are you living the 5? All right, have a great one, and we will see you in Unit 3.